Hey, what's up, everybody? Welcome back to Investing Sucks, and this video is going to be another installment of the Your Company, My Analysis series. I haven't done one of these in about a month, and I had a subscriber recommend this company, and I thought it would make for an interesting video because it's a company that appears to be very, very cheap when you look at it at face value, but when you start to look below the surface and peel back some of the layers, then you do uncover some real issues and some potential threats to the business. So that's what I want to talk about here today. So as always, if there's another company you'd like me to cover in a future video, feel free to suggest it in the comments. Of course, I can't promise that I'll get to every single company that people suggest to me, but if you do want your company to have a chance of being featured in a future video, then do make sure you drop a comment of that company and also tell me why you think it would make for an interesting video. What's unique about the company? But anyways, the company we're looking at today is T. Rowe Price. So first, let's take a look at who is this company. So what do they actually do? So if we look at the description, we can see that T. Rowe Price, they are a mutual fund company primarily. They do offer various investment management services, but primarily they are a mutual fund company and an actively managed mutual fund company at that. So the way the business works is they create various types of funds, mutual funds. They do have a small amount of ETFs, which we'll talk about that later. Typically, the funds will have some sort of focus, right? So it could be a focus in a certain geographical region, a certain asset type, whether you're talking about growth versus value investing, they're looking to capture some sort of specific market and then market their funds to investors that are interested in that particular market. So because T. Rowe Price is a asset manager, a key metric we'd want to focus on is assets under management, because that's really what's going to drive their revenue and going to drive growth in the business, which if you're investing in a company that offers mutual funds and pensions and specific types of funds, the key metric you're going to want to focus on to know if are you going to earn a good return on your investment is, are they increasing the assets that they manage? Because then they can charge more fees on that and so forth. So they provided a pretty in-depth breakdown here, and we can see that US mutual funds account for about half of their assets under management. So about $871 billion, and they have about $1.6 trillion total in assets under management. So they're a pretty big company, right? Almost 2 trillion in assets under management. And of course, that's a number you're going to want to monitor and make sure it's growing on a year-over-year basis. And we can see here it has. It's gone from about 1.5 to close to 1.7 trillion dollars. And they also break it down by assets under management in the various asset classes. So equities, we can see their majority in equities, which is interesting because we know, at least in US markets by and large in 2022, equities have lost quite a bit of value, right? Especially if you basically you're owning any index fund, you've probably seen your portfolio go down this year. Only really specific investments like oil companies, fertilizers, some insurance stocks haven't lost value this year. And they do have some in fixed income as well, but they are primarily a mutual fund company and specifically in equities. So they do have other assets as we could see here, but that's primarily what they are. The thing that's interesting to note about their AUM here is we can see that they have a very, very small amount in ETFs, right? You can see only about 29 billion, or even some of that, that's not even all ETFs. It's kind of grouped into this area with other types of accounts, which is interesting because we know ETFs have become extremely popular over the last 10 years. And actually, I was able to pull up this research here, which shows a pretty clear trend in terms of the difference between actively managed mutual funds and basically all other types of passive investing in ETFs. And so this chart, it captures it pretty well. And, it's a pretty clear trend as we can see here. Basically, actively managed mutual funds are having their entire or part of their market share eaten away by ETFs and passively managed. So the key difference between a passive fund versus an active fund is with active, you have a portfolio manager that is selecting investments. Typically, they're looking to beat the market and earn the best return. And they also typically will charge higher fees for that added effort. Whereas with passive, it's really just tracking an index, right? It's not trying to outperform. You're not selecting any investments other than just the investments that make up that index. So it's mirroring some sort of performance. So there's a pretty clear trend here where almost in perfect lockstep, investors are moving their money, because this is measuring fund flows, which is a pretty common metric that's used in the fund management space to compare like how investors are allocating their funds, if they're putting it in bond funds, ETFs, mutual funds, whatnot. And it's a pretty clear trend where investors are moving their money out of actively managed mutual funds into passive funds and ETFs, right? And to be perfectly honest, this is probably the most important trend in the investing world that has taken place over the past decade, because this represents a complete change in investors' attitudes on whether or not they think actively managed, so outperforming the market, is worth the risk, and if the higher fees compensate for that. And there is pretty clear research out there that shows that some of these active managers, they are able to outperform the market, but after fees, you're underperforming, which kind of defeats the purpose of it, because then you're really just enriching the fund managers, right? Which, does kind of make sense, but that's a topic for a different video. And besides that, there's many reasons why ETFs and passive investing is just becoming more popular. For example, we all know it's just easier to buy ETFs, right? You just open a brokerage account, you go buy them as if they're stocks basically, and they tend to have lower expense ratios, especially the larger ETFs that track indexes like those offered by BlackRock, Vanguard. I mean, the cost of these is basically negligible, whereas actively managed funds will usually have higher fees in the range of 1.5%, maybe even 2%, which is quite high. And if you're holding those funds for long periods of time, that 1.5%, 2% does eat away at it. And you're also generally more diversified with a passive strategy. So this is an ETF. It's SPY. So it's a very common ETF that a lot of people in the US would own. And speaking to this diversification argument, some people recently at least have been arguing against diversification when it comes to these ETFs, because if we look at what companies are actually made up of these ETFs, we can see that there's a very large chunk that's large cap tech stocks, right? Apple, Microsoft, Google, Amazon, Tesla, Nvidia. These are all massive companies that make up about close to 20-25% of the entire index. So if large cap tech experiences a pullback, then you're not really diversified in that case, right? Because 20% of your portfolio is in one specific type of company, right? And you could argue, I mean, those are great companies, which they are, but if valuations are high and they correct, then that does kind of defeat the purpose of the diversification strategy. So a better example is an ETF. This is VT. It's another very common ETF, Vanguard Total World Stock. And if we look at the top holdings, they're going to be the same: Apple, Microsoft, Amazon, Tesla, but the allocations are much lower here, right? You can see 3.5% in Apple, whereas we go here, it's almost 7% in Apple. So this company literally owns every company in the entire world, right? It's globally diversified. So in my opinion, I think with ETFs, globally diversified is the way to go. It just makes more sense, because if you're in ETFs because you like diversification, then you should also diversify across regions, right? Because you don't want to expose yourself to one specific region, even though the US, of course, has had a pretty strong stock market historically. You never know what the future may hold. So in my opinion, that's just the way to go. But anyways, that was kind of just a side rant on a completely different topic, but it all kind of ties into the idea that, we're looking at T. Rowe Price. They are offering mutual funds, and this is a very real risk that their business faces, is the fact that investors aren't really liking actively managed mutual funds, and other funds are eating market share. If we go to their 10K, I'm here on page 15, and this is the risk section, and they quite literally, they call this risk out, and they say, look, the market environment in recent years has led investors to increasingly favor low-fee passive investment products. As a result, investment advisors that emphasize passive products have gained and may continue to gain market share from active managers like us. So they're recognizing the risk. They're saying, I mean, it's pretty clear, yes, this is happening, and it's a trend that's not in our favor, but what their response to it is they just believe that there's going to be a strong demand for strong performing active management, which is true. I mean, investors are going to want to put their capital in the hands of the people that can do the best with it. And if you have a good track record, then that's going to speak to that, and you'll naturally attract more capital that way. So it really comes down to, can T. Rowe Price actually continue to perform strongly, right? Because if they are active management, they have to perform well. Otherwise, if they don't, then investors will just withdraw their money and go elsewhere, and maybe jump on the passive train as well. So this is, in my opinion, this is the most key issue with this company, is how well can they perform? Can they increase their AUM, which leads to higher fees, and actually, kind of reverse this trend and remain competitive despite it? Okay, next thing I want to do is look at some valuation metrics for this company. So I do this with pretty much every company I look at, and I like to start with the price to sales ratio. Now, some people don't like the price to sales ratio. I personally love it as a way of looking at a specific company, looking at the price to sales over long periods of time and see how it changes, right? Because it can change for mainly two reasons. One, the company becomes more profitable, right? So for each dollar of sales, that translates into more cash flow, which will naturally raise the price to sales ratio. Or if sentiment around the company changes, right? Which that's probably what it's going to mainly be. And with this company, we can see the sentiment has reversed very strongly with the price to sales ratio here. And we look at what it was in kind of mid to late 2021, about 7 times, and now it's gone down a lot to about 3.7 times. And if we drag it back even further, I'd imagine it would probably hit an all-time low in 2008, which it did here, which, that makes sense. It's typically in the range of kind of between 4 and 5. It was a bit higher here though. So this reveals a lot. For one, we can see that investor sentiment around this company has changed quite a lot, and we can see that reflected in the stock price. I mean, they've lost 35% in 1 year, which I don't know how in line that is with the market. To me, it seems that that's a bit lower than what the market has done overall in the past year. But it does kind of make sense when you think about it, because if the market as a whole is declining, and we know this company has their fees dependent on their assets under management, their assets are now worth less, so their fees are going to be worth less. So the only way they can really offset that is if they are able to take in more money from new investors, right, and increase their AUM, not by increasing the asset value, but by bringing in new capital from new investors. So later we'll see kind of what that trend was. They do provide detail of that in the 10K. But the other metric I wanted to look at was um, price or enterprise value to unlevered free cash flow. So this one here. So when I show you the DCF, which I did do a DCF valuation for this company, then I think this will make a bit more sense. But as we can see here, it's kind of a similar trend, right? It's gone down in recent years. Overall, it's typically in the range of between 15 and 10. It usually hits 10. A 10 ratio here seems to be quite low. So in terms of this ratio, now would appear to be a good time to buy this company. But of course, this is just one ratio. It doesn't tell the whole story. So next thing I'd like to do is go to the section of the 10K that actually talks about kind of the fund flows that they're experiencing, because this is going to be very telling. And they've given us 3 years here, which is good. Now, if you're really interested in this company, you'd probably want to look at back further years, but I think 3 years will generally give a good understanding of where this company's at. So there's a lot going on this screen here. We can see there's a lot of different numbers, but I'll direct your attention to this item here, which is net cash flows before client transfers. So client transfers here, this isn't really that important. This is really just investors moving money from one account to a different account. As we can see here, 23.2 billion, and that pretty much exactly equals what, or this outflow here equals the inflow that was here, which is for the 2019 year. But this net cash flows before client transfers kind of represents whether or not investors are depositing more money with T. Rowe Price or removing it, right? So here they actually had a $7.6 billion inflow. But if we look at the future years, it's been an outflow, right? 11.5 billion outflow here. And then down here, we can see 4.9 billion outflow. But despite this, or that's for US mutual funds specifically, but despite this, their assets under management continues to increase, right? So even though investors are, at least for the mutual funds, they're moving their money out, their assets under management are increasing. And the reason for that is because of the actual market appreciation. So you can see here, if we look at the kind of the total, 233 billion in 2019 in market appreciation. So that's what brought their AUM from just under $1 trillion to 1.2 trillion, was pretty much mainly just the fact that those assets increased in value. And then in 2020, it was kind of the same thing. So 260 billion, which was the primary driver of their assets under management. And then again, 205 billion here in the most recent year. So that's how they're increasing their assets under management, is because of this market appreciation and income. So their investments are doing well. So that does kind of speak to their overall performance. But we do know that in the year 2022, stocks aren't doing so great, right? So if we take a look at their quarterly revenue. And the reason I'm looking at quarterly revenue is because this is going to tell if that trend is changing, right? Because if we look at their most recent quarter, and if we see it was a decline from the previous year, or if it went up, then that's going to kind of tell us, okay, maybe their assets under management is decreasing, which means their revenue is also decreasing. So that's going to be really important. So once this loads here, minimize this. So we can see their revenue for their most recent quarter, which they reported at the end of March. So still a lot of months where the market has gone down a lot. So I would probably expect some revenue decline there, but they actually increased in revenue from this quarter versus the last. So from Q1 of 2022, Q1 of 2021, their revenue went from 1.82 billion to 1.86 billion, so about a 2% increase. So even though I think at this point the market had gone down a bit, they were still able to increase their revenue. So it's not like if the market decreases 30%, T. Rowe Price's revenue is decreasing 30%. It doesn't move perfectly in lockstep. But despite that, we could expect, at least in my opinion, we would expect in the next quarter their revenue to be down a bit. So that's probably why, if we go back to the valuation metrics, they're valued so low currently, is because there's a bit of a decline being priced in here, which personally I think is reasonable. But remember, price of a company and the value aren't always going to be perfectly correlated. So what I want to do next is go to a DCF model that I did, and break it down and compare the price to the value and see if, even if the company does decline, could they still be a good investment? Okay, so here is the DCF model. Now I will post this DCF model as an Excel file in the link in the description of this video in case you want to look at it more in depth. I'm really just going to give a high level overview of my assumptions here. Now, I did make one tweak to this model. If you guys have been watching for my channel a while, you'll know that I use this model pretty frequently. And that is, I had this item in here called share-based compensation. So share-based compensation for T. Rowe Price was a very significant item, and it is listed as an expense on the income statement for companies. That's how it's accounted for, but it's not a true cash expense, right? So if you're doing a discounted cash flow, you'd want to add this back. But the way you account for it is because of the share-based compensation, their shares outstanding are going to increase in the future because they're giving shares to their employees, right? So now, despite that, they may still be buying back shares. So with this company, they are actually still buying back shares and decreasing their shares outstanding in spite of this employee stock ownership program. So basically, I have their shares outstanding decreasing by 1.5% a year for the next 10 years, which is about what it's been historically for the past 7 or 8 years. So I'm really just taking the historical trend and projecting it forward. And then in terms of the actual expense of share-based compensation, I have it growing at about 9% a year, which again is historically what it's been doing. This might be a little high, especially in these later years, but you do have to recognize that a company like T. Rowe Price, how they're going to actually retain their employees is by giving them share-based compensation. So as the business grows, as their employees grow, they're going to need to offer this program more so that their employees stay. So that's basically what I'm saying with that. Now, I do actually have their revenue declining by 1% for the next 4 years and then increasing by 2% the years after that. And this is really how I'm just trying to account for a decline in the market overall, right? Now, I can't exactly predict what the market's going to do, right? Which you kind of have to do this, or you have to do a little bit of guesswork when you're trying to value a company like this. But in order to just be more on the conservative side, I'm saying, okay, let's just see what happens if we assume their revenue decreases. And then their EBIT margin or operating margin, I basically just assume that it'll be about what it has been historically and fluctuate a little bit. So it'll increase at about 0.2% a year. So it goes from 44% here to about 46%, which I think is a reasonable assumption. So then let's just skip right to the bottom again. If you want to see the details of this, I'll put a link to it in the description. But basically, with all those assumptions of EBIT margin, revenue growth, tax rate, give a 12.5% terminal value multiple. So for enterprise value to unlevered free cash flow, which is in line with what we saw, it's currently at about 10. So I am assuming that that multiple is going to expand a little bit in the next 10 years, which is a pretty optimistic assumption, I think. But let's just see what the result is when we put that in. So we get a fair value of about 100, just under $200 a share. So, and the current price is $125 a share. So current price is about 63.8% of our calculated fair value given these assumptions, which personally I do think these are more on the optimistic side, which would give us an estimated annual return of just under 15%. Now, me personally, I'm looking to target 15% because that's how you know that one, you've built a bit of a margin of safety in there. You're projecting that you're going to earn at least 15%, which historically would beat the market. So even if your assumptions are a little wrong, then you have some leeway there so that you'll still earn an okay percent return. And in terms of a fair value, personally, I think you should be looking at the 50 to 40% range. So you want the current price to be either half or below of your calculated fair value. So personally, I think given these assumptions, which again are a little optimistic in my opinion, the company isn't quite at the buying price, but it is interesting, right? I mean, this is a pretty good return overall, and it does appear to be at least a little undervalued. But let's revise the assumptions, say this goes to 10, which is what it's currently at. So that brings the annual return down to about 12 and a half. So it went down about 1.5%. And then if we say we assume 0% revenue growth in the future years, and then the near term -2% revenue growth, it's still an okay return, right? But it's less undervalued now at about 80%, but still overall is a pretty good return. So pretty much what I would conclude from this is that this company is interesting given that it's valued so cheaply. The sentiment around it does appear to be very negative, which as a value investor, you can take advantage of that pretty well. If there is a negative sentiment around a company that is overblown, you can take pretty strong advantage of that. But personally, I think that the risks that this company faces are very, very prevalent, right? Everything when we talked about like the trend of passively managed funds that's literally stealing market share away from actively managed mutual funds, to just the fact that they are going to have to really rely on their investment performance because the primary way they're increasing their AUM is through market appreciation rather than attracting new capital. So if that isn't able to continue, then the company's revenue could decline. So personally, for me, this is going to be a company I'm avoiding. But I do think that if you really look into this company and you have a solid foundation for believing that even despite those risks, they could still prevail, then I wouldn't be surprised at that at all. This is a company that it's been around for a very long time and it could still make for a good investment. But personally, for me, I am going to avoid this one. But anyways, guys, that pretty much does it for this video. So thank you so much for sticking around and listening to my analysis. I know this was a pretty technical video, so I hope you did find it useful. And if you did, leave a like and subscribe if you are new to the channel and you'd like this type of content. And I'll see you guys in the next video.